All right. Welcome to the Trading Pit, your virtual gathering for sophisticated traders. It's January 18th, and it feels, honestly, like the market is slow to a snail's pace, and that's just fine. We're going to break it down for you. This is Marconi White. Today, I am joined by two of my favorite analysts, JJ and Ben Lilly. We're going to help us decode the markets. I'm going to dive into the analysis with JJ, but first, I want to give a special shout out to CoinCall, who is sponsoring this video. For those of us who joined earlier this week, you may have heard this, but I'm going to do it anyways. CoinCall is committed to unlocking the full potential of cryptocurrency trading by making options and futures understandable and accessible to everyone. And CoinCall offers a full suite of options, futures, and spot trading of your favorite crypto assets with competitive fees and an elegant interface. And to give you an idea of just how great CoinCall is, at the end of this episode, JJ is going to be diving into his DGen trade of the week and reviewing that. You're not going to want to miss that. All right, well, we can get this started. JJ, I'm going to kick it off with you. As I said at the beginning, it feels a little slow, but tell me, are the Bears in charge? Are the Bulls coming back? Or maybe it's just boring time?
Yeah, this looks like full bear territory here. So we've lost a lot of momentum here on the daily chart. We're actually now below the 50 to
well, we got to put it out there. We got to give a little levity, because when anytime the Bears are in charge, it just feels like the air is taken out of the room.
Yep. So we actually lost the 50-day moving average, and we've kind of been consolidating below that all throughout this week, which is not really what you want to see. The momentum that drove us up, you could see how we were holding these trend lines the whole way up to 49K or so last week. And now that the air's just kind of been let out of the balloon, the market's having a tough time absorbing all of that spot coming from the Grayscale trust, and it's just been pretty firm downward momentum. So we're kind of running on borrowed time here to make a move back to the upside into the end of the month.
So I was going to say, so the spot's looking weak. We've broken down a little bit. And the Bears, this is similar to what we talked about on Tuesday. Anything from a spot perspective that's kind of maybe caught your eyes? It's, in the last 48 hours.
There hasn't been anything massive. If we pull up Coinbase's order books here, actually there's been buys outweighing sells here in terms of volume since the ETF. So that's an encouraging sign if it can continue, but we would need to see some really strong spot buying, I think, coming on Coinbase over the next few days to push this back up. There is some fuel above. Ben had a nice write-up last night in his article. This is showing us liquidity pools. So if we can somehow make a move to the 44K range into the end of the month, there's a lot of shorts here that you see highlighted. So that would give us some nice squeeze fuel, possibly another pop back over 45,000. And maybe we could reconquer this momentum here, get back into an uptrend. But I think we would need to see something pretty soon here, probably before the end of the week, something to confirm upside.
All right.
Right now we're not seeing it.
JJ, the bear, walk us through that. Bring up the liquidity chart, liquidation pools that you just showed us, because we were going through spot volume. Is this spot? Is this perpetual? What are we looking at here? And just walk it through for the audience who maybe isn't familiar with the data.
So these red dots you see here, these are going to be short positions that would get liquidated if we reach this level. So if price were to move back up into this range, these are spots where shorts would have to buy back their position, and that would have a reflexive effect on the market where they would have to buy it. It would push price higher, and we could potentially see a squeeze back over 45,000, maybe into the end of the month. But I think this would be dependent on spot volume sending us back up into that range, because right now supply is so heavy that it keeps, every time price is making a walk up, like we saw yesterday towards 43,000, it just keeps getting smacked back down. So that supply-demand dynamic would have to shift in favor of buyers, which we're not seeing yet, in order to get that spike back up and start hitting these liquidation pools. Maybe we could even make a run back up to 50K. You see that short liquidity is there. That's what we would really want to see, is that momentum switch back in favor of the bulls, but it's not here now. So waiting patiently to see some kind of reversal here, especially in spot markets over the course of the next couple of days.
In terms of volume, how does the volume profile in terms of open interest look like right now? Because I know you mentioned there's a couple of areas where you could be hunting for some of that liquidity, but is the volume there today? Has retail or someone else piled into large short positions or long positions that typically give us some kind of volatility?
It's overwhelmingly long, which I don't think is a positive thing. So if we look at this here, this shows the aggregated long short ratio. So when it's higher, there's more longs in the system, lower, more shorts. And right now it's at the highest it's been since June. And as we see, price didn't start going up until those longs start to close out. So the market kind of always works in the favor of whichever side, the path of least resistance, right? So when there's too many longs, it's difficult for price to move up because market makers are trading against them. So typically we see these long shorts ratios drop down and then price can move up. And right now we're hovering around the highs, which makes me think that we need to see some of these positions close out in order for price to move up. If not, we could see some downside liquidation hunting. If we go back to that chart, we see that there's pools down around below 42K. So if price were to break down, that would have an exaggerated effect due to the dynamic of that is when longs get hunted, they're forced to sell their position. And the same way it's reflexive to the upside when we see short squeezes, it's reflexive to the downside when longs get squeezed.
Ben, gray-eyed Lilly, I want to bring you in here, ask you a little bit about some of this liquidation pools and the analysis that JJ just presented, because when we were just talking offline or before the show started about some of the AUM being absorbed for the ETF. So now we have a new vehicle that could change the way some of the spot metrics are going to present themselves. At least I would think it would influence that, right, in terms of volume. What's your perspective on how the perps and liquidation pools are going to influence price in the near term?
It's a good question. When it comes to the near term, these liquidation pools, a lot of this is just about finding that liquidity to either go ahead and do distribution, if that's what the market's trying to do, or is it there to enable accumulation? And right now, it feels more like on the distribution side. So a lot of times if you're a trader looking to open up a position or set stop losses, you're trying to look at these upside price points. But then when you want to go ahead and find out where there's going to be a lot of velocity in price, you'd be looking at those downsides. So where's price going to slow down? Where's it going to speed up? Liquidation pools here are very handy for those type of scenarios. And the liquidation pools on the downside that we showcased, let's see, early this morning, late last night, depending on what your time zone is. The liquidation pools to the downside, I find important because last time that JJ and I were on the show just a couple days ago, we were discussing that if price were to go ahead and go below this kind of $40,000 price range on the lower side, volatility is going to pick up, right? The market's going to it's going to have fear creep in. You're going to see prices dislocate a little bit, and it's going to generate significant liquidity. And if you kind of see how this distribution is unfolding at the moment, that's almost needed. It has to happen. Like we talked about how well this market is being in terms of liquidity engineered for most of last year. I mean, this whole run from the start of 2023 all the way through has been incredible to watch, and how it's been working hand in hand with the options market. You can't ignore it. You can't ignore how the structure is taking place within options. And as far as what we see right now with implied volatility pricing, which is again that risk premium associated with how much price is moving up and down. As price moves up and down a lot, there is more premium on those contracts, and they're very suppressed right now. And it just seems like an anomaly given that price has ripped from about 25,000 to almost 50K in such a quick window. And typically volatility in that pricing only gets expressed on downside moves. And I have to think we're going to see that shortly. And I think one of the reasons why is kind of what JJ and I were going back and forth with before the show, which hopefully we get into a little bit later.
Yeah, well, I definitely want to get into that a little bit more. So I think right now it sounds like from a pressure standpoint, it's starting to build and looks like we could see some more downside. Is that what I'm hearing from both of you guys?
Yeah, and to Ben's point as well, there's some gamma forming at 42,000 in the form of puts. So we see this here over 250 million in notional. So if price goes below 42,000, once it breaks that level, the rate of change at which market makers will have to hedge those puts that they sold becomes rapid. The way they hedge that is by shorting or just selling spot. So it could accentuate that move to the downside. You add on top of that liquidity pools to the downside and whatnot. And we could see kind of an explosive spike in volatility towards the downside. If we look at the implied volatility chart, this is just fallen off a cliff since the ETF launch. It's a pretty wild move to see happen. So I think inevitably this is going to spike back up. When it does, most likely to the downside, it seems like the path of least resistance. Like you look at the amount of open calls, these green bars, there's way more calls to the upside, which means market makers want to protect those positions and they don't want price to get here because this is where they lose money. So if you look where are market makers trying to push price, it's going to be most likely to the downside, as that's the path of least resistance here.
Okay. So everything seems to suggest that we've lost momentum. We're sitting in a range now at the 42 to 45. We don't seem to have a large amount of demand coming in to take out supply. And the positioning now looks like it's starting to favor the movement more to the downside. As you mentioned, we've got more longs than shorts, and there just isn't enough momentum to kind of carry this forward. So it looks like a bit of a reset is on the table at this point.
Seems likely, yeah.
And just to talk about just supply and demand factors, there's with the ETFs, I think the supply dynamics are changing because of the Grayscale vehicle. Right, there was billions and billions of dollars locked up of Bitcoin in there, and things are changing, and those Bitcoins are now moving hands. And where is that supply going? Is the new destinations of that supply offsetting the change that's taken place within the Grayscale vehicle? And then really, if that isn't, where would we see that show up in the market? That kind of brings us back to what we were discussing at the beginning, which is, it feels like distribution's happening here.
If you think about like the Grayscale trust, there was billions and billions of dollars locked up in that. And a year ago, it was trading around $7 or so. And now it was above like 40 last week. So those people got a get out of jail free card, essentially, with this ETF. And the amount of selling that took place because they got bailed out, essentially, it's just been overwhelming any new demand that I think is coming in by making these products accessible to institutions and whatnot. Like, I don't think the demand has outweighed the supply. And we've been seeing that play out for the past week. For sure. And you add on top of that, people that were speculating on the move up throughout the ETF, kind of the run up to it, they had to take profits. So it's just an overwhelming amount of supply that's coming into the market over the course of the past week or so.
Yeah, like you pull up on Y charts. I pulled it up on my screen here. I was a little late to screen share, so apologies, producer, on that. But if we're able to pull that up, it's around $28.5 billion as of last week, right? And since then, we've had the ETFs roll out. And if we go ahead and we pull up what their figures are at now, as of yesterday, it's over $3 billion less in terms of AUM. That's a lot of Bitcoin hitting the market. That's a lot of supply. And so is the market absorbing it? I read a news clip that said BlackRock has surpassed, I forget the number I saw, but right now
like
it's
16,000 BTC or something.
And that was over $1 billion. I think that was the stat I saw.
Yeah, that sounds about right.
Okay, because they're reporting 700 million on their sheet, but that might have been updated. That still leaves a lot of overhang. And if Coinbase is really the market where we're going to see a lot of kind of this spillover effect in terms of the spot markets, like we can go ahead and bring up I pulled it up on my chart, this white line that we have here. This is Coinbase minus what the price is on Binance's spot market with Tether. And so I think I flipped it. I think it was the other way around. But right now we're just seeing that Coinbase is actually showing a discount when it goes negative. And it's significant, right? When was the last time we seen it this low? Not a good time period, right? This was early November. Last time we saw this spread exist. And this has to be where a lot of supply is kind of showing up. And so when is it finally going to be too much and the market's going to break down? I think it has to happen here shortly. I kind of have some old red lines, vertical lines here from an older espresso post where I talked about how this spread would, once it goes negative, it tends to showcase that there's a bit of an overhang in supply in the market and the demand's not actually kind of meeting it. And so it gives it soft conditions overall.
Ben, I want to pick on this a little bit because we talked months ago about the notion that the ETF was going to sideline a lot of people. They're going to expect that an ETF goes live, massive amounts of demand come in like week 1, week 2, week 3, and price just moves in one direction up only. And you talked about the fact, well, keep in mind that infrastructure has to be built out for funds to be able to get exposure to these ETFs. There has to be approval from boards. You're going to have the rotation perhaps of Grayscale that you just mentioned, and the supply has to go somewhere to be absorbed. I feel like what's playing out now, just as we're starting to look at this, could take several months to play out where we're unlocking supply. There's not enough demand in the market yet. And we see a retracement on price for Bitcoin, and it's just a buy opportunity for long-term investors. But I mean, is this not part of what you telegraphed months ago, or was this part of your expectations?
Of course it was. What are you talking about? No.
Do you want me to put up the T-ball? Should I do more of a softball here?
Yeah, no, I want a beach ball.
There we go.
No, lessons to be learned from history always, and just going back to the gold market and how that ETF process happened. 2003. I hope these dates are right because these are old lines on my chart that I haven't pulled up for a while. But I believe that's when the first ETF hit. I think that was Australia, and then just over a year later, the first U.S.-based ETF hit for GLD right here, and you can see price kind of topped out. And I drew all these other lines right here just to showcase like price didn't really rise much after that. It took a little bit of time for those channels to show up for various portfolios to start accumulating that ETF and gold. A lot of prospectus needs to change on various funds that want to go ahead and increase their exposure to gold using that vehicle. And then once they're kind of set up, we're off to the races. And this was 2011 or 2005, 5-6 years of just straight up only.
Yeah.
Is that going to take a whole year? Probably not. Right? I would like to think that TradFI is a little bit more efficient now. So it's not going to take so long. It's not going to take a year, which is, in a way, is kind of exciting. If April, I think it's the 22nd, I looked at it last night, for the halving that's coming up. And typically and historically for Bitcoin, whenever we get to the halving and price goes above the 200-day moving average, on the weekly basis, we don't get a close below the 200-day moving average until after the peak is in. That's a pretty awesome stat. And if we go ahead and line it up with what we're talking about here with GLD and what happened with this multi-year bull run, if TradFi is a little bit more efficient, it's not a year, maybe it's 6 months, maybe it's 5 months. That's pretty interesting timing that we're starting to fall into. And so it's good. It's very good. And regulatory pressures and that overhang that's taking place there, like I wrote it last night, it's like hitting anti-gravity in terms of price discovery. It's nice.
And you think of how much supply is being distributed now with the Grayscale unlock too. Like there will come a point of just seller exhaustion some point into or after the halving. And you add on the halving factor where supply gets cut down. Like it's just kind of creating a perfect storm. Once we get through this period, probably towards the tail end of Q1, it should be off to the races.
It's great. It's a healthy correction. This little kind of change of hands with Bitcoin, it's fine. Let it take place. Take some time to basically get ready for the second half of this year because we'll be storming out of the gates once it decides to pick up. Let this correction happen. If it does happen, what I'm really interested in is what you hit on the other time, JJ, which is does the plunge protection team show up? And
Yeah,
I have to
that's the X
agree
factor.
with you on that point. Like I think they're going to show up to some degree. So this correction and this pullback, does TradFi want people to get scared? No, like they have a product to sell. They need to make it as appetizing as possible. So to your point, like I'm curious how they come in here.
I think it's going to depend on if legacy markets pull back as well, right? Like if we see, I'm sure we'll get to this, but if we see Dixie blow off and all markets kind of go through a liquidity drain period, I could see Bitcoin going a lot lower. But if it's just Bitcoin falling kind of in a silo, I think we'll probably see some level of plunge protection around 36K or so to really prevent the bottom from falling out. But if all markets fall under stress, then I think it's right back to the same old volatile downside we saw in previous cycles.
Mm-hmm. Mm-hmm.
And I do want to give a shout out. Excuse me. Pancake Lord has asked for some Dixie analysis in the chat. Pancake Lord, we're going to be getting to that. Yeah, it's coming. It's coming. We can't let that go. Adam S asked about the BTC selling pressure versus buying pressure. I think we've explored that one pretty well. The other question he had was, if BTC drops, how much of a drop should we expect in mid caps and micro caps? And I think our messaging on that has been so consistent. With a delay, we're expecting exaggerated gains and losses. But how would you guys respond to that? What would your base case be if we saw Bitcoin drop below 40K? Where do you think it would go, perhaps? And then what would that mean for the rest of the market?
I think it's like beta gives and beta takes away too. So you're basically playing with leverage running alts. So you're really dependent on Bitcoin holding like that 36 to 38K range on any drop down for the bottom not to totally fall out of alts. If Bitcoin were to drop back to the 200-day or even below around 33,000, I think you would see alt annihilation. Like I struggle to see any scenario where Bitcoin goes that low and alts hold their level in any meaningful way, just because of the reflexive dynamic of it. Like when Bitcoin goes up, altcoins go up more, and when Bitcoin falls, they just get decimated. So I think you should probably have a plan in place in case we do fall this low to 33,000. That's not entirely out of the realm of possibilities over the course of the next month or two. So definitely be aware of that and don't be over allocated to alts. You'll have plenty of opportunities to get long alts at that bottom, right? Like that's really where you'd want to look for some exposure to see how Bitcoin performs. If it holds this level and consolidates here, that might be a good time to start looking for alt exposure. Even if you wait for it to break back above 40K later in the year, your risk reward is going to be a lot better than if you're buying alts now and basically praying that Bitcoin doesn't break down,
Well, I do want to ask, last show, we talked about the fact that if Bitcoin can range for a period, this could be a little period of relief for the alts. And Ethereum can get a bit of a bid. Maybe we're going to see that in the rest of the market. Are we seeing that, or are we seeing that the market is just a little bit cautious right now? It doesn't really know what to expect.
I think Solana had a nice pump yesterday. So it seems like this 42 to 47K range is really like the sweet spot for alts to take off against BTC and against the dollar pair. But basically below 42,000, it's probably extremely risk off for alts. And I think if Bitcoin got above 47,000, we'd probably see like that Bitcoin milkshake play out where Bitcoin takes all the liquidity away from alts and starts raging to the upside. But it doesn't seem like that's going to be happening anytime soon.
Ben,
So I think it's more risk than reward for alts right now. I think you're kind of playing on borrowed time.
Well, I want to ask Ben, because I know he's got his mini trade account so he can refurbish his home. Any thoughts there as you're looking at that account to see if you need to be doing a different rotation, maybe bringing ETH back to BTC or just doubling down on ETH or even further down the risk chain?
Not alts, that's for sure. Now's not the time to be playing with fire with the supply overhang taking place, do the ETF movements and shuffling hands around. And what we discussed on the last episode, as well as kind of espresso, I kind of said there's a lot of headwinds and what we're seeing with the dollar, which we'll get into in a little bit. I find it hard to be risk on right now.
Yeah.
Like moving down into ETH, I think is fine, but not like full allocation wise. I still think like on my chart, like we got above what was essentially a breakdown on the chart. We kind of reclaim that territory. Could we see a retest of it as support? Absolutely. I think JJ is looking to see a retouch on the low, not necessarily saying like it has to happen before he gets interested, just saying that it's definitely a possibility and we need to be alert on it. Like if we pull up the dominance chart, kind of speaks to this question, is our alts going to be able to kind of continue to tread water if we get a sell-off? Like I have to think no. Before the last halving in 2020, the dominance did dip quite a bit beforehand, and then it started to gain strength up until that point. We've kind of broken trend recently. It's kind of the similar time period until the halving, where we had this march higher, liquidity milkshake took place, and then it kind of gave way to the rest of the market. And now as we get closer, I think it's either going to continue to go sideways or inch higher, right? Not like a full-on rip, I don't think, unless all these ETFs surprise the heck out of us. But I still think it's a little bit too early for that. I think it needs a little bit of catalyst on the macro front for that to really take off. But yeah,
Okay.
so to answer the point, I think it's a little bit, be tentative. Alts were very generous over the last 6 months. It feels like even further, and we should be grateful for it. We don't need to get too greedy. We're going to have another opportunity or two, right? That will come. So just stay patient, and those opportunities, let them come.
All right. So I think the narrative there is fairly consistent. This is a risky time to be in alts with the potential of a rip down for Bitcoin and some of the dynamics there emerging with the ETF. All right. Well, we're going to jump in to the Dixie and give that analysis for Pancake Lord and everyone else. But before we do that, we've had a lot of folks asking, how can they help support this show? They've enjoyed it. Well, I want to say the first thing you can do is hit the like and subscribe button and turn on the notifications. That's going to let you know from YouTube when we're available. It's also going to get us out to as many people as possible. Now, if you want to do more, there's the ref link to sign up for CoinCall. And I mentioned this at the top of the show for those who didn't hear. CoinCall offers a full suite of options, futures, and spot trading of your favorite crypto assets with competitive fees and an elegant interface. And signing up using our ref link helps us with the show and helps us continue to grow. So those are all things that you can do. I would say the last thing that you can do is share this show with as many people as you can. Either people in real life, or if you're in chat rooms and looking for some good analysis of the market, go ahead and share the link from here. It just helps us get out to as many people as possible. All those things I think are a great way of you supporting the show and helping us grow. And with that, we're going to jump right into the Dixie. Last show, JJ, we were talking about the fact that Dixie was looking strong, and the end of the month was really the pivotal point to look at. I guess from your perspective, has anything changed in the last 48 hours? And is it still the end of the month that's really going to show us some fireworks?
I think it's just been getting stronger. So we actually had another news failure event today, which is when news that would typically cause Dixie to react one way is forcing it to react the opposite. So jobless claims came in and they were lower than expectations. This would typically send Dixie down. In this case, it's sending it right back up. So this is not really what you want to see if you're looking to add risk in this scenario. So if we look at the daily chart, it's had clean breakouts here. Now it's trending back above its 200-day moving average, made a clean break of the Bollinger Bands. This is just a clean uptrend since the beginning of the month here. Looks like it's ready to rip on that time frame. We're running into some resistance here on the weekly time frame, but this is basically the last point of resistance, the 50 RSI mark here. If it gets above here, the damage to markets could be catastrophic. So this is not something you want to fade against, especially when all of the news sentiment that was driving Dixie lower is now pushing it higher. You see those adverse reactions, something is changing in the market, and it's kind of giving you a warning signal. So until you really see a strong reversal from Dixie back below at least 103, preferably 102, and it looks like it's going to start heading back to those lows from December, it's not really the time to be looking to add risk, in my opinion. The downside's too great. And as we were talking about before, like the path of least resistance right now is down. and Dixie is moving up, and that's kind of telling you risk off. So this is adding fuel to that potential downside if it doesn't reverse here into the end of the month.
Okay. Ben, well, I was going to say, it just feels like it's just a bear hour here. There's not a whole lot I can do about that. We take the tea leaves and we tell you what we think of them. But
I wish it were different. It's just, it is what it is. Like you see these things, somebody like when Dixie topped, it was in October, right? And then you see it fall down, and that's exactly when Bitcoin took off. Maybe a week or two after Dixie topped, Bitcoin started running up. But this whole way that Dixie was running up, I think Bitcoin was around 30,000 at this point, and then it obviously traded all the way down to 24,000 in early September into October. And it wasn't until Dixie broke down that we saw Bitcoin start moving up. So you don't want to be on the wrong side of this if Dixie starts to catch a bid, because it takes all of that liquidity out that was driving price up over the past few months.
Yeah.
So when the tides change, you have to adjust.
Well, Ben, I want to bring you up here because you're the rates guy. You're always looking at those to see what path that they're going to suggest the market moves from a Dixie perspective. You know, we're not geopolitical analysts, so we're not going to try and really give analysis there. That said, we know that there's a series of events that could impact that, right? We talked about the inflation data coming back. You talked about job reports. Right now, there's a discussion in the U.S. Congress about the next funding bill. And of course, you've talked about sort of the notion of the Fed and the market expecting rate cuts. Is there anything that you've seen just, again, in the last 48 hours that are starting to suggest what could be even more fuel for a Dixie run up, or perhaps take the oxygen out of the room and cool it down a little bit?
Yeah, I mean, you can actually compress that to the last 48 seconds. So while you guys were talking, I was trying to pull up some recent speeches again from the Fed, but I'll get in that to just a second because it's kind of an interesting note by Governor Bowman, but I'll touch on that in just a second. But what I have right here is the Fed Watch tool by the CME Group. And so this kind of talks about what the likely probability is of what rates will be after the conclusion of the FOMC meetings. And so for the March, so January, the market is not really expecting anything. There's a small group that thinks they're going to have a 25 basis point cut, but expectations right now are that rates will remain unchanged. So then March becomes really the target of when we think cuts will happen or they will remain unchanged again. And we're pretty split here. So if something's going to impact markets, this March and the run up to this March meeting is going to be on the table. And we kind of see this change over the last month. I think earlier this month, we were saying that the Fed is in a position to underwhelm the market's expectation of giving it the amount of rate cuts that it's expecting. And we've seen this change. Like, this is the current amount that the rates are set at, 525 to 550 basis points. A month ago, we're at that it will remain unchanged at 31%, and this has crept higher. And then expecting a one rate cut has dropped significantly during that time span. So right there, you can see the Fed is trying to hold rates higher for longer. This is not doing a slowdown in the market, but it's making the dollar kind of have its run. And it's going to be kind of paired up with the recent dollar's run, which is the kind of increasing, I don't want to say hawkishness, but more like just digging its heels in the sand on its rates. But to get to what I just kind of got into this morning while you guys were talking, which was the recent speech, it actually talked about the Basel endgame. And so I think we talked about this, feels like many moons ago, 3-4 months ago, but they're actually beginning to discuss the change in capital requirements at banks. This is kind of the first I've heard it of this year. I've been waiting for this to kind of hit the press, and here it is. And they actually talk about the leverage ratio requirements, which we have discussed before. So why is this? Go ahead, Mark.
I was going to say for the audience here, I think we talked about the notion that banks, at least U.S. banks could potentially use the treasuries that they have on their books that they have to hold as collateral. Am I talking about the same topic there?
You are. So right now, trying to go back, I didn't really prep on this, so I'm going to draw a few blanks and stumble my way through this.
I gave you a softball earlier. Now this is the curveball. You got to be on your feet. You got to be ready to swing.
This is like a knuckleball.
Yeah, knuckleball.
Very difficult subject to ad lib.
Yeah, that's right.
Yes, it is. So capital requirements, a lot of it has to do with the amount of risk that regulators put on that capital. And treasuries is not a risk-free instrument. There is some risk associated with it. And so banks need to hold some capital in reserve against those assets. And on the global playing field, if we're going to use baseball terminology some more, is that they are risk-free. U.S. treasuries, you don't need to have capital requirements associated with them. So there's been an expectation that in order to meet these new capital requirements, that they would kind of loosen up those standards. This would be silent, in my opinion, silent QE, because it's going to unlock a lot of capital on various balance sheets. And this is what I believe we're going to probably be discussing over the next month, because the U.S. Treasury will go ahead and make some announcement at the end of the month saying what they're going to be doing for future allocations and distribution of debt, and trying to raise that capital to finance itself. So here we see the plumbing is starting to position itself to allow more treasury issuance coming up. And it's important to take note, right? This is free. This is more money coming into the system. This is going to free up a lot of balance sheets. It's going to reduce any liquidity concerns that might exist and kind of raise the comfort level of the market. And paired up with kind of what the dollar's doing now, I have to imagine that this rally in the dollar is going to run until we kind of see this get addressed.
Ben, I think a point about this when you shared it with me several months ago was that this is almost an overnight change, right? Whereas you have auctions for treasuries and there's periods between those auctions. This is, well, whatever you have on your books, one day, now the next day can be treated differently. Now, banks have to go through some internal procedures and controls. They're going to have to update some reporting. But in effect, you've overnight changed the amount of liquidity in the system.
Yeah, it would be like if you have a mortgage on your home, and that's considered debt. You go ahead and you want to open up a new loan. That's looked negative in a negative light, right? Do you want more of a credit line? No, you can't really have one because maybe you have too much debt. Your mortgage is too big relative to the amount of income that you're earning. But then let's say tomorrow, that house is then turned into an asset.
Yeah.
Right. That completely changes it. Now your credit lines can be opened up, to the moon. Right. It just changes everything in an instant.
Just so I understand that correctly. So if you say a bank had $1 billion of treasuries, right? This in effect would unlock that $1 billion and they could put it into markets theoretically.
They have a very small ratio on it. I think it's like 3%, 4%. So, if you have $1 billion, you just take 3 to 4% of that. You need to have that on reserve.
Mm-hmm.
So if that moves to zero, which is what they're kind of getting to, that frees up that capital.
Gotcha. Yeah, that would be massive.
Yeah, no, it'd be a massive change. It'd be overnight. It'd be interesting to see how that works out. When we talk about the liquidity coming into the market, and does it come in through loans to commercial? Does it go to retail? Does it go to housing? So there you have overnight access to liquidity. The question is, where does it actually go and how quickly does it arrive?
And this addresses what's happening in the reverse repo market. Right? Everyone's saying like, oh man, it's almost empty. It's declining at a very significant rate. Like, oh my God, what's going to happen? We need to stop, rolling off the balance sheet at the Fed, stop doing QT. This is addressing it. Like, this is their solution to what's coming. And so this is something to keep an eye on over the next month.
Yeah, it's going to be a very interesting change, and I think for all those who are out there, maybe not as interested in the accounting changes. If I'm not mistaken, there's an interesting fact here, and it's impacted markets, I think, since the great financial collapse in 2008. I'm pretty sure it was at that point where the banks were forced to buy up treasuries. Is that your recollection, Ben?
I think the Fed stepped in, if I'm not mistaken, and kind of acted as a backstop to give the confidence. More recently, they kind of said that, we're going to treat treasuries as par value, which the market was not saying that treasuries are par value. So the fact that the Fed was willing to go ahead and kind of lay that baseline, that gave confidence to where it was needed.
Okay. Well, and the facts there do matter, and unfortunately, I'm on my toes. I'm not doing a great job, but the reason I bring that up, this is all relatively new. This is not decades worth of policy they've been acting. Most of what we're talking about now is all net new, with the capital requirements that have gone in the last decade, the intervention that's happening by the Treasury, by the Fed into the markets. It's been massive and new, so it leads us to some uncharted territory, which is yet another reason to show up every Tuesday and Thursday at 9:15 Eastern to hear what we're saying and how we're breaking down the market, because there's going to be something that we haven't seen before that we're going to have to break apart. But I think the Dixie is just giving us another sense of what to be worried about in terms of where the market could go. As JJ, I think you point out, this is kind of a risk off period. It's tough to say this. It's time to be risk on. And then perhaps
the important thing to remember there too,
Oh.
with Dixie, let me just overlay Bitcoin to show you this kind of lag effect, is that Dixie will top and it'll give you time to get into Bitcoin after it tops. So look here in October, Dixie topped out at 107 in early October, and it wasn't until 2 weeks later that Bitcoin really began its run up, right? And we see this time and again. Dixie topped in, what's this, early October, late September of 2022. And then Bitcoin obviously had a ways to go. It wasn't until January. So there's not really a rush to call the top on Dixie. Like people, you want to rush in the second you see it reverse. But it looks like a new trend is starting. So until you really see a firm reversal there, I don't think there's any reason to rush in. There will be plenty of upside when it does eventually top and starts to come back. But, why risk? You could get an entry at 42K, but maybe you get an entry at 45K, and your risk reward is so much better if you're certain that Dixie is falling into a downtrend. But the times when it's trending like this, it's very difficult. And it gives you that lag period, a grace period where it tops and you can still get favorable entry points. So that's just kind of my 2 cents on it. You'll see a lot of things spike up too, like implied volatility will start to rise up before price makes any meaningful movement in one way or the other. We see that time and again too, is Bitcoin tends to follow the rise in implied volatility. And right now there's not much interest in options market, and I try to follow their wisdom, right? I'm not smarter than most of the people that are trading options in size. So defer to the smarter players in the room and wait till you see some movements.
And if there is a bit of a sell-off, like just even in the equities market, watch Bitcoin, how it responds. Like the way that it's responding right now to the dollar is pretty good, right? It's showing some strength there. And the fact that it's moving into kind of this long, hopefully 12 to 18 month bull cycle, this is a good sign. It's showing its strength, what it needs to show some strength. Dixie can keep ripping higher. Sure, Bitcoin can have a correction, but it's not going to be looking to make any new lows here.
Yep.
And so,
I mean, ideally, Dixie tops out here. Like we see this, it's right on resistance. It's rejected from here multiple times throughout the past year. So if Dixie tops here, we see it reverse below 103. It starts heading back to these lows. That's risk on. I mean, I don't care if we're at 45K. You're still below the highs of last week at that point, and I think that's a risk on signal. But don't try to rush it because you think Dixie topped. There will be signs beforehand that let you know that. So
yeah, I could see that happening at the upcoming FOMC meeting. Like, because the 30-year is still trending higher. We said there's a lot of correlation with what's going on with the rates on the 30-year Treasury and the Dixie. If Jerome's going to go ahead and address, what is the expectation for 2024? I think the rates, if rates remain unchanged, you're going to see that kind of top out. and he's going to say, look, rates are going to be higher for longer. Yes, we're going to look at softening, and he might give some dovish comments in the meeting, given some of the recent economic data that's been coming in. But that to me sounds like a period where it's going to line up with Dixie kind of topping out,
Rugged
yields topping
Jerome.
out, and then
Rugged Jerome.
I thought we were going to pay less attention to him, I swear, but here we are.
Yeah, maybe that's one of the calls that didn't work out. We got a couple of questions from the chat. I think we've done what we can on the Dixie side. Certainly for all those who are listening, you want a little bit more. I suggest you come back again every Tuesday and Thursday, 9:15 Eastern. We're going to be here. Dixie is always something we're going to cover. So as it evolves, be it on the capital requirements, what that means for liquidity, specifically to the Dixie index, we'll be covering that.
Yeah, we haven't even digested that, to be clear. Like I was just reading it as Marconi was asking me that question. So hopefully I can read this speech and give a little bit more color here shortly. But
what I was going to say, we did have a question here from Adam that I don't think we're going to get to today. So we'll plan on coming back perhaps next week. Again, this is a theme that's going to take place, as you said, over the next month or longer, in fact. But it came from Adam and said, did they, in this paper, make mention of an increase in capital adequacy ratio? If so, would that cause banks to tighten it? Wouldn't it? If they have to hold more capital? Just curious. So I think we'll take that question offline and get I think a deeper analysis over the next couple of weeks. And when Ben's back, maybe we can drill him a little bit more on that. I did have another one from Adrian Fluter. He's asking about the GBTC being absorbed via OTC, and does this affect the overall buy pressure? I think we covered this pretty well. Is there anything else you'd want to point out on that front, JJ, Ben?
I think that's probably what we're seeing is they're selling at OTC. It might just be moving from Grayscale to BlackRock or Fidelity, etc. We just have to wait to see. Like, they might be distributing it in small chunks here. We haven't seen a huge amount of sell pressure in terms of spot on Coinbase since last week. So we know Grayscale is obviously losing Bitcoin. Where that's exactly going, it's not clear yet. It's not clear if it's just been transferred from one holding partner to another. So we'll see.
Yeah, and on the negative side, like I don't know how quickly these redemptions happen. Like they might take a little bit of a time to process. Like it's not just, hey, you pick up the phone or you send an email and then you can redeem your Bitcoin within the hour. Like this isn't the blockchain. This is TradFi Rails. So it's going to take a little bit longer. So we might not even actually see most of it yet. I don't want to cause any unnecessary fear, but
nobody panic.
I feel like it's a little early to really be able to see some of these fingerprints, if you will, on where the movements are going. So I think it's a good question. Again, I think it's something that we continue to come back to over time as we see sort of how the market digests the launch of the ETFs, and then as we start to move into Q1, Q2, and we see sort of the how they're performing as well as how the volumes are adjusting over time. Okay, so I think with that, we've done a good assessment of where the market is, where we think it's going, at least before our next show. I want to move in a little bit to trades. And there's a question here, actually, was exactly what JJ and I were talking offline before the show started. And it said, what's your thoughts on MicroStrategy and coin, et cetera, basically the equities that are tied to crypto and Bitcoin? Are those yesterday's BTC proxies? Are they yesterday now that we have ETFs, spot ETFs? So I guess the question is, in general, do we expect that the proxy BTC trades to be dead now that the ETFs are live? Or in fact, are they going to continue to trade perhaps as a beta to Bitcoin and still be a good opportunity? And JJ, you were talking about MicroStrategy offline, talking a little bit about the pattern that you saw just for the last couple of months as price skyrocketed and has since pared back a bit.
Yeah, it was interesting, right? It was a massive short squeeze, essentially, on all these stocks. So 2022, early 2023, there was so much short interest in these, right? And the market was not prepared for the catalyst of a spot ETF, and the signal of that didn't really register until October. And if you look at MicroStrategy here, it was one of the craziest uptrends ever, but it was all driven by that short interest. So people just kept shorting into an uptrend and they just kept getting blown out. But then obviously you have the sell the news effect, people don't need MicroStrategy, miners, coin, etc. to get exposure to Bitcoin anymore. They can just buy the ETF. And this became like a popular short pairs trade where you short one of the beta plays and you long Bitcoin. And it's performed quite well over the past week if you did that, because these went down much more so than Bitcoin. I do think, like, if you see Bitcoin resurge above 50K, I do think these will still outpace it due to beta effects. Until we really see an uptrend in Bitcoin where it's running alone, I think those beta plays have happened consistently. So I think people can assign whatever narratives you want to it or whatnot, but there will be so much short interest that if Bitcoin starts breaking out again, these things will run along with it. That said, they're looking ugly right now. They need quite a lengthy period of consolidation in their current ranges. And you really need people to start shorting it again, essentially. Like we were talking about before, markets move in the path of least resistance. So what do you need? You need people to bet against these things and then Bitcoin to eventually break out and drag them higher. It's going to take some time, though. Like, I don't think these are going right back to the highs anytime soon.
JJ, some of the narrative there around shorting MicroStrategy, I'm imagining, must have been that the old narrative that we've heard now for over a decade, that Bitcoin isn't worth anything. It doesn't make sense to invest in it. And so you have a lot of TradFi that basically says this is an easy short because it's going to zero. Does that change over time?
We'll see. I mean, who knows? But I think what happened in 22 and 23, people see the clips of Sailor. He sounds like a crazy unhinged person. You think, oh, this company's going to go to zero. I'm going to short it. And then when Bitcoin rips up, he looks like a genius. And you have the adverse effect of people buying into these tops because they think it's going to 1,000, you know? So markets, they're just reflexive. And this is just a good mirror of that, where you see markets get totally offsides. It was the same thing with coin and miners. The market was so over short those stocks, thinking that Bitcoin wouldn't break out and seeing it as a proxy in the event that Bitcoin went to zero after things like FTX and whatnot, that it just became easy to squeeze. And then it squoze. And now that's over. Like, there's not the same upside juice as there was previously. A lot of those positions closed out after the ETF news. It actually became a popular short. So I think you kind of saw the closing of those pairs trade. That's why we're seeing like MicroStrategy's up 3% today. That's probably a short covering bounce. Like, it fell from 700 2 weeks ago to 480, 460 earlier this week. And naturally you just take profit. You say, okay, I was long Bitcoin, lost some money there, but I made a lot of money in this MicroStrategy trade, close it out. So we're seeing a little bit of bounce back to the mean, but I don't think it'll be sustained for very long. It's probably going to consolidate for quite a bit.
So I think, coming back to the question, are these beta plays going to stay in play? Your perspective
above 50K,
is,
yeah. I think they'll rip and outpace Bitcoin.
Okay. All right. So
in this range, like, I don't think there's much alpha to be had in trading those while Bitcoin's just kind of chilling in this range. I think there's a lot of downside if Bitcoin falls below 42,000. I think that beta effect comes into the play on downside too. So if Bitcoin goes to 30K, you'll probably see this fall back to like 250, 300 or so. It'll be a strong breakdown. And same thing for coin, Mara, etc.
Right. Well,
they're leveraged Bitcoin. That's how I look at them. They're just leveraged products with a different wrapper.
And deep markets to play them in because of the options markets that already exist for them. Okay. All right. Well, let's get into the very last element, which is the DGen trade. We started this on Tuesday. Excited to have it. It gives anybody who's looking for some high risk, high reward plays something to consider. So walk us through what you looked at last Tuesday and how it's performing.
So I still think these are favorable. I'm looking at the February out of the money puts that expire on February 22nd. So if you look here, I think anything 40,000 and below has the potential to really multiply if we get a shot of vol to the downside. So we see implied volatility is very low, which means the premium you're paying on these options is very low compared to where they were a week ago when implied volatility was at a score over 77. So your premium cost is a lot lower. And if we do see that downside manifest, if we get the 42K break, you'll really start to see the gamma effects on these pick up. If price falls into a black hole and we start seeing longs liquidated, we could fall down to 38K in a single candle. These would probably jump up to be worth over a couple thousand each at least. So I think that's a good risk reward, right? And you have a lot of time to expiry here. It doesn't expire for another month, so it gives time for the trade to play out. I think if we do hit these long liquidation pools, this would really provide the best point of entry. because we'd see that squeeze up to 45K. These would drop in value probably by like 20 to 50% or so. And you could buy them even cheaper. And I still think that downside scenario into February is likely. So I think that's a good trade to put on in the near term, because I do think volatility will hit to the downside more likely than the upside.
And just so we repeat what we say on every show, or at least we should say on every show, this isn't financial advice, as we call it. This is a degen play. So there's
I'm a
a lot
janitor
of
on the
risk.
internet, so you have to take that for what it's worth.
Yeah,
right?
that's
Like,
right. That's right.
Don't take your financial advice there. But.
Yeah, don't take financial advice from a bunch of avatars on the internet. Okay, I think with that, we can wrap up today's show. Really appreciate you guys coming on here and breaking down what feels like a slow market, but the fact that it's starting to show some signs that it's going to be potentially consolidating, taking us down, I think is good for the sophisticated trader to know. So I appreciate all that. For those who came in today to live show, thank you for showing up. We enjoy having you here. We love the questions. Be sure to show up every Tuesday and Thursday at 9:15 Eastern, where we're going to be here with a variety of analysts breaking down the market, answering as many questions as we can to give you guys the alpha so that you can live your best life in the trading world. All right. Well, with that, I'm going to wrap it up. This is Marconi White signing off. And as I will say every single week, be sure to have a little bit of dry powder, especially now that we may see something going down. We may see some pullback here. All right, let's break it up.